Okay, fantastic. Well, thanks, Pierre and BCI for giving us this opportunity to present to you. And I thought today, yeah, it's always good to talk about our funds, which I will do at the end. But I think it's important, as Helen has mentioned as well, to have a philosophy and a process in place. I'll share with you our thinking in terms of our philosophy and process. And then, of course, there are quite a few factors that are driving interest rates in our markets at the moment. I'll discuss a few of those, and then I will also look at how that is implemented within our funds and portfolios that we do manage. But I think the first thing is, as a operation, we do not operate as a machine. It's effectively people. And that's the importance. So without dwelling on the slide, I think just to mention Katie's is Katie's is an asset manager, a full-on asset manager. We focus on fixed income. That is our speciality. And as you can see from the board or on the screen, there's many years. We've got a couple of gray hairs, a few of us. So we've been through a few of the cycles to see these things happen. So the people in our organization is quite important. And the way we've constituted the team in terms of their knowledge and skill and experience is actually shining through very well for the asset manager. I'd like to start off maybe a little differently from Helen. I'd want to start off with our philosophy. And I think philosophy should be quite simple. And our philosophy is quite a simple philosophy. It's saying that we provide incremental outperformance over time within defined risk parameters. And I think this is quite important because we're not a house that's going to be trying to shoot the lights out. What we want to do, and it's probably something that Helen mentioned as well, is make use of that compounding effect that one gets by being just a little bit outperforming on a small basis over time, and that compounds and that starts spiraling in an upward direction. You actually make things very, very meaningful in terms of the returns that you get over time. Obviously, risk is very important because you cannot manage a money market fund with cryptocurrencies in it, for example. And similarly, if you're managing a bond fund, being too conservative might actually let you down as well. So I think it's important to consider the risks within your ambit as a fixed income manager, and those are quite important. And that embodies our very, very simple philosophy, but I think it's backed by a very solid process. But before I get to a process, I thought I'd just quote Lewis Carroll, and we may remember who Lewis Carroll is. He's the guy who wrote Through the Looking Glass, or Alice in Wonderland, as we more commonly know it. And he said, if you don't know where you want to go, then it doesn't matter which path you take. And I think this is quite important. If we don't know where you want to be, and Alan quite nicely indicated what their targets are. I think if you don't know where you want to be with your investment, any road will take you there. So it's important to have a focus. It's important to have a target. It's important to know where you are going with, whether you're managing fixed income, equities, properties, or whatever the case may be. I think your process should actually back that up. So just in terms of our process itself, I think as far as the fixed income environment is concerned, it's very much determining the directional movement of interest rates. Which way are interest rates going to be going, so that you can position yourself accordingly to take advantage of those movement in interest rates. For us in the fixed income environment, when interest rates are coming down, it's quite nice for our bonds. We can actually get capital gain out of it. But of course, for the money market instruments, you're getting less of a return, and you have to be more competitive, and you have to be more innovative in the way that you actually construct your portfolios. But nevertheless, having a focus of looking at the directional movement of interest rates, we employ a technique which we call top-down. I know top-down is a little cliche, but it's important that you interrogate your economic fundamentals, such as your growth, your currency, your inflation. I think it's very important that you interrogate monetary conditions as well. In other words, we know tomorrow the Reserve Bank will be announcing the interest rate decision, and we put ourselves in the shoes of that Reserve Bank and try and figure out what the decision is going to be doing, what the decision they will be making, so that we can align ourselves with that. I think it's important that you do your homework as far as valuations are concerned, whether you think that certain instruments or sectors are undervalued or overvalued, and you can take advantage. I think there's even a small place for technical analysis as well, because there are players in this market that are playing the momentum game. And that gives you an indication. It's not the be all and end all of our strategy, but we do make a small some small room for that within our process as well. And then, of course, the international environment is quite important. We've seen all the different uncertainties across the globe, and I might speak about one or two of them. The important thing that I'm trying to say here is that there is no one factor that influences the directional movement of interest rates. There's a myriad of factors. And we tend to get sidetracked by hot buttons at times. Oh, it's the US or what the Fed is going to be doing. Oh, it's inflation at this point in time. Oh, it's growth. Oh, it's uncertainties as far as tariffs is concerned. And we tend to align ourselves with one or two major events. Yes, those are important, but generally those are short term. And the markets, I found in my humble experience, is quite resilient, and it actually works and looks through those cycles. So therefore, we have a bottom-up process as well, because, you know, if you have a top-down process, we can switch on in the morning and switch off at night and play golf for the rest of the day. But I think it's important that even though I don't play golf, but it's important that you actually manage your process, you manage your portfolios, and that you have to decide at some stage what security you're going to buy, what bond you're going to buy, valued at what level, how you're going to manage your duration and your sensitivity within your portfolio, what risks are playing out in the scenarios that surround these particular rates, if the rand should go one way or the other, for example. And then, you know, as bond managers, we all love a yield curve, and no presentation is complete without showing a yield curve. And, you know, but I think the yield curve tells you so much about the expectation that is out there in terms of rates, as well as inflation or expected inflation. And then, of course, the credit environment that we live in at the moment, even though we've seen spreads narrow and that environment become quite tight, is quite important in our lives as well, in terms of the portfolios that we manage. Now, I think the important thing is here, you know, it's all good and well to do all these things, to look at all the factors, to look at the monetary conditions, the economic fundamentals, do all your analysis. But you need to be able to make this real. You need to establish a level of conviction. In other words, how do I actually make this real within my portfolio? So it's good to say, right, we're long duration, but how long are you? How much risk are you actually going to be taking? How sensitive are you going to be making your portfolios? And I think that's the important part of the process that we employ, is we actually establish a level of conviction on a very regular basis. Just before I get to that and translate that into our portfolios, a few of the pertinent issues that are driving rates at the moment is a few global factors. And I want to chat through a few local factors, because I think that's important as well. And the first one on the board is global growth, because we've seen that growth, even though it's been resilient, maybe in inverted commas, we've got lots of policy changes on the cards at the moment, and that's going to present a lot of challenges. We know this is not a presentation about US tariff policy changes, but that has created a lot of uncertainty and has at times actually stifled the growth or the significance of growth in the global environment. And then there's been quite a fall off in consumer confidence in the US as well. What does this mean? Theoretically, lower growth is actually a indicator of lower yields as well. And I think that's part of the reasons why we've seen, even though in the past we've seen US treasuries, for example, the yields blow out or continue on a negative trend, we've now sort of seen a bit of leveling off. And I think this is part of the reason, because of the challenges that there is in the growth environment. Obviously, the inflation environment is quite topical as well in determining the directional movement of interest rates. And we've had these pressures starting to creep in certain economies, even though we've been in a lower inflation environment, and certain aggregate inflation has expectations have moved higher. We've seen that through goods price inflation that's been rising. And of course, everybody is waiting now with bated breath as to how the inflationary effect of the tariffs will feed through to the markets and in the fixed income markets in particular. I think, and to inflation in particular. So I think we still need to see a few prints before we can make a call on that, or a definitive call on that, because it takes time for these issues to work through the market. Of course, very importantly, it's quite important to consider growth and inflation, but the central bankers have a very challenging task at the moment to apply monetary policy. We've got the Fed that meets today or completes their meetings today, and it's widespread speculation that there'll be a potential rate cut. But I think it's become very challenging for those central bankers to remain vigilant under the underlying inflationary pressures that are there, and whether the policy rate decisions that's flying around as far as tariffs is concerned is going to have an influence on their decision. Nevertheless, I do think that there is room for the US to cut the rates, especially with the labor market statistics we've seen recently. Just bringing it home, and I'd like to look at the same three factors in the local environment. We know for a fact we've got a low growth environment, which should keep a lid on our yields as well. And I think the growth environment that we've been experiencing effectively has been as a result of low business confidence, low consumer confidence, high unemployment. And even the SARB has lowered their growth forecasts under a 3% inflation regime. And I'll speak about inflation in a second. And then, of course, we've got all the global tensions as well. So the lower growth environment is kind of keeping a lid on our interest rates at this point in time. As far as local inflation is concerned, I think at the risk of going through all of these things, and anecdotally, and I put a little note at the top where, and this I took straight off the SARB's website, where it says the family braai has become more expensive, while prices for several breakfast items have eased. Now, anecdotally, it does feel that the consumer is in a pinch at the moment, but we are coming off a very low base as far as inflation is concerned at this point in time. So you probably will see year-on-year numbers. That's the mathematics. We'll see inflation ride. And the food price inflation, which affects a large part of our populace, is also quite sticky. But because we are in this lower inflation environment, we've got the SARB targeting intentionally or less formally maybe, or not as formally, but targeting a lower inflation regime, it could very well keep a lid on yields as well. And then the last thing I want to mention as far as factors that are driving the interest rate environment is obviously our local monetary policy. And we've got the SARB meeting tomorrow, or they're meeting today and tomorrow, and will they be cutting rates? Is inflation and the new target that they've set implying lower yields? And even though we know for a fact mathematically inflation will rise on a year-on-year basis because of the low base, but I think it's quite a challenge at the moment, and the potential for a rate cut is there, but I think the SARB is going to be very astute in the way it views the global environment. So I think the important thing, what I'm trying to illustrate here, is that there are lots of factors influencing our interest rate environment at the moment. There's not just one factor. There'll be one driving or major factor maybe at one point in time, but you have to take all of these factors into account. And we do that through our process, and we derive through a systematic approach, a proprietary approach, we derive a level of conviction. And most certainly, I can tell you, even though we've come through there, you can see sort of the post-COVID period where we've been fairly negative about the markets. And then since last year, we started picking up in terms of the positivity that we've seen in the market. And we've actually benefited from being longer. And the graph that is on screen at the moment, if the red line or the red bar is above the neutral 0%, then that does mean that we are bullish or longer, and the longer the bar, the more bullish we are. And below the line means that we are less bullish or bearish on the market. Most certainly, by looking at all those factors, we are in a position to say that we do have a longer stance in terms of the way we've positioned our portfolios in terms of its sensitivity. Now, to wrap things up, because I know I'm rabbiting on a little bit, forgive me, Pierre, but I do think it's very important, even if you've got a level of conviction, you've done all your homework in terms of understanding the factors that drive interest rates. You've done your homework in terms of establishing a level of conviction, like we are a little bit long at this point in time. Your portfolios are dictated and governed by things called a benchmark and a mandate, and these differ. They're not all the same. So when we construct our portfolios, we have to look at what the mandate is saying in terms of the universe that we can invest in, the target, the goal that you're trying to achieve with that mandate, and then what are you being measured against? And you know, I always say that a benchmark has got two main functions. The first one being it's a yardstick against which you can measure yourself, an appropriate benchmark, and then it also helps you define the universe that you are involved in. And that is what we do when we do construct our portfolios. For today's purposes, I'm going to focus on two of our funds very briefly. Our money market fund, which is on the low end of the spectrum, and our bond fund, which is on the high end of the risk spectrum. I'll leave out for now, and we'll just look very briefly at our enhanced income fund and our absolute yield fund, which falls in the multi-asset space. So once again, as Helen has mentioned earlier on, we've got diversification within our enhanced income fund. It's a Regulation 28 compliant fund. It's a fund of reasonable size. It's about 2.6 billion in size at the moment. We use credit quite significantly within these funds. We've diversified over 200 counters across 40 issuers, and it's what we term designed for all market conditions. This fund is designed to beat its benchmark, which is STEFI Core plus 1% on a constant basis all the time. We know that's what we're targeting in terms of our philosophy and process I mentioned earlier. That is what we're going for. This is a battleship. It's an icebreaker. It's designed to achieve that. And most certainly, when I show the performance numbers in this table we've got here, we're very proud that this fund, in its history, which is now about 14 years old, has been benchmark beating as well as peer group beating. It's not designed to shoot the lights out. We do realize that we are in an asset category that is very diverse, that multi-asset income category, but we're there to deliver to our clients what we promise them in terms of managing expectation. And I've said this over and over again, what the label says on the can is what you will find in the can. So you can be very rest assured when investing in our enhanced income fund. Our absolute yield fund employs a little bit more risk, is more assertive in terms of the risk. It has a more aggressive benchmark, reasonable size as well, close to 2 billion. And it uses the bond market a bit more actively than the floating rate markets in terms of our bond and asset allocation exposure. So you'll have diversification across the asset classes, which includes inflation-linked bonds, money market instruments, bonds, and floating rate notes to achieve its end. And similarly, when you look at the performance, you'll find that it is benchmark beating and also peer group beating, also in terms of its mandate and in terms of its goal. Pierre, I've said a hell of a lot now, so I'm going to stop there and say thank you, Nza Kenza, for my colleague who helped me put this presentation together in Tsonga, and thank you for your time.